Go watch the videos for YouTube. Expand.
Okay, recording.
The guy too good.
Recording started.
Kai. Okay.
How far can you guys still hear me?
Yes, we can hear you.
Sorry, network went off. I had to switch to another network provider. These MTN people with their wala. So sorry about that.
No problem, boss.
Let's just
Hope
run
it's
through.
okay now.
We've switched to another network. Hopefully this one will hold. So I don't want to take much of your time. Let's just run through this because this session is actually very important. I believe that everybody needs it. It's also recording. So we'll run through it and then we'll send the PDF to the community. All right. Okay, I think my screen is sharing now. Okay. Let me just minimize this one. Okay. Minimize this one. Okay, can we still see the screen, please? Can we see the screen?
Yes, I can see your screen.
All right.
Yes.
So the first set of
yes.
The first set of rules we talked about are the foundation rules that preserves your capital. Without capital, you're not in business. No matter how good your setup is, no matter how good. And again, please, I want to just put this out there. Do not be on demo for too long. Demo is just to see if your setup works. Do not be on demo for too long. In fact, there are some professional traders out there, they say don't even trade demo at all. Because if you are trading demo for too long, it makes you feel like you are so good. You will not develop your psychological edge to trade a live account. I've actually flipped a demo account from $1,000 to 10K and all of that. But when you get into a live market, the game is different because now emotions are involved. So demo doesn't train your emotions. It just tests your strategy, but it doesn't test your psychology. And psychology is an important aspect of trading. So you need to know how to keep your capital, to maintain your capital, not to lose it. Capital preservation is more important than capital growth. Before you can start talking about making money, you should talk about keeping money. That $1,000, don't lose it. That $100, don't lose it on your pursuit of $5,000. See how you can just grow that money. I've said it in this part where I say never risk more than 1%. If you don't have enough equity, if you don't have up to $1,000, you can buy a proper prop firm account and start testing your edge on that prop firm. You can even lose the prop firm account. It's fine. You can lose it because when you lose it, what you actually lost is the money you paid in acquiring the account. You did not. If you are trading a $10,000 account, you did not lose $10,000. You lost whatever it is you spent in buying it. So your emotions are kept in check. Meanwhile, you are refining your edge and all of that. So quickly, let's go to the second one, which is the structure rules. For the particular model we trade, which is SRP, structure, range, and POI, one of the structure rules says never trade against the higher time frame structure. Never trade against the higher time frame structure. And we'll take our higher time frame structure, we'll mark our structure on the 4 hours. Once we see our valid structure on the 4 hours, we don't trade against that structure on the 4 hours until 4 hours changes bias, until 4 hours changes structure. That is when we are going to change our structure. But if 4 hours stays bullish, we are bullish. If it stays bearish, we are bearish. Even though 15 minutes may be bearish, 4 hours is bullish, we don't take that 15 minutes bearish trade. Okay, never trade against the higher time frame structure. If structure is unclear, stay out of the market. Confusion is a no trade signal. In fact, trading, professional traders, you wait more than you execute. 90% of the time, you are just sitting on your hands. You are just waiting for your setup to form. You are waiting for your setup to trigger. And you are waiting for your setup to play out. There are 3 levels of waiting. The first one, waiting for it to form. You mark it. Number 2, waiting for it to trigger. If it has formed, it has not triggered, you wait for it to trigger. When it triggers, now you wait for it to play out. So you can see that there's a lot of waiting in this market. It's a cycle of waiting. The actions you take are very minimal. You just execute and wait. Trace hits you out, you wait for the next setup. You mark your next setup, you wait for it to trigger, it triggers, you wait for it to play out. So you wait more than you actually execute. If structure is not clear, you wait, stay out of the market. You can look for another pair that aligns with what you are trading and all of that. Once structure breaks, accept the new direction immediately. Do not be attached to a bias. Oh, this pair is bullish, this pair is bullish. Now this pair breaks that bullish structure and goes downwards, confirming a bearish bias. Yet you are so head on the bullish trade because you are not looking at the bias from the higher time frame. From the higher time frame, maybe 4 hours broken structure, you are still looking for 15 minutes buy setup. It will not work. Broken structure to the downside. So trade only in alignment with the higher structure. If structure shifts against your trade, is it without negotiation? You could be in a trade. That is why this is why you need to learn how to set your SL in the exact invalidation trade in invalidation zone. There was something Kevin Talent said. I think you guys should go listen to that space Twitter space session. Kevin Talent, Chris and Sabigel. It is a 3 hours lengthy space session. It will help you. Kevin Talent says something that he trades 1:2, 1:3. His SL is people say, oh, your SL is too big. The SL is where it is supposed to be. The SL is big because he trades on a higher time frame. The same thing with DAX. When you trade on a higher time frame, it seems like your SL is big. Don't try to push your SL. Maybe you go to 3 minutes. You want to put your SL in a place. That 3 minutes SL is not an invalidation zone. Price can take you out and still go your way. But if price takes you out on the exact invalidation zone, that means that price has changed bias. The market has changed bias. That means you do not just lose the trade. Market actually went against you. Market created a new bias. Okay? Never add to a losing position. You are in a massive drawdown. You want to stack positions. Don't do that. Wait for your trade to play out, especially when you are starting out. You are not yet a profitable trader. Don't start stacking. Sabigel was saying she's going to teach stacking. She's going to teach stacking. Finally, she taught stacking. People have not even learned how to take a trade to TP. They are talking about stacking. Take a trade 1:2, risk $50 to make $100 first. Don't add to a losing position. This one is when market has taught you. From your personal experience, market will teach you. You will learn stacking by yourself, how it works for you. But for now, just trade what you see. Okay, now that is for structure. The next rules here are the range rules. Please define the range high and range low. Some of us don't know how to mark range. I think we are still going to revisit it again. You mark a range. There are bigger ranges, there are smaller ranges. It depends on the time frame you are marking your range. If you mark range on daily, mark range on weekly, mark range on monthly, it is different. We trade on the 4 hours. So mostly we mark our range on 4 hours. We use daily and all of that for structure. We mark our range on 4 hours for this particular model. The range high and the range low, they are very obvious. But some people will go and mark from inside the range, which is not the range low. When price comes down and takes them out, it thinks like they think that it has invalidated their trade. Meanwhile, the trade is still, the range low is still holding, maybe on a bullish trade, or the range high is still holding on a bearish trade. Your stop loss must be outside the range. When you mark the full range, your stop loss should be below. If it's a bullish trade, below the range. If it's a bearish trade, above the range. Slightly, maybe 4 pips, 5 pips ahead or thereabout. Some people do 10 pips because when sometimes news we push price, it will react to clear liquidity and it will come and still go your way. So 10 pips is okay. Just 10 pips outside of the range. This one says partial profits should be taken at 50% of the range. Didn't know how to take partials until I took so much losses, until I went on YouTube and watched how to take partials. Some of us here might not know how to take partials. It's not something to be shy about. Go and learn it. How do you take partials? Once you have a running trade that is running on profit, this particular model we trade demands that you take partials at 50%. Or you can even take full profit. But you can take partials, 50% of partials, and then hold the trade to TP or whatever happens in the trade. This model demands that you take partials at 50%. If market has given you 50%, it has tried for you. Let nobody deceive you that it is TP or nothing. That 50% is a lot of money. If you think it is nothing, lose it and keep losing it, and you see where your market, where your this thing will be. This is a lot of money, and it helps you psychologically. How does it help you psychologically? You are not in a panic mode, especially when you are just starting out. Your account is on a drawdown. You want to bring the account out of a drawdown. You want to grow that account fast and get to payout or pass the account. 50% should be able to give you partials. You can take 50% of your profit. You can close out 50% of your position in the market at the 50% fit level. You can use your Fibonacci to mark your entry to your take profit. Once it gets to 50%, you should be able to take partials, something very tangible. This is how position traders take their trade, because when you trade higher time frame has a lot of reactions. It will be reacting from breaker block, fair value gap, order block. It will just be reacting, and sometimes price will go as high as 80% of your trade and reverse back to entry and continue again. Why not take some partials when it comes back again and the structure is still valid? You enter. If the structure is still valid and it comes back to entry, you should take another position. But if it doesn't come back again, it will give you full TP. Meanwhile, you've already taken 50% of your partials. This is how this model works. While we are teaching these rules, it is perfectly aligned to this model. If you're going to trade this model, these are the rules for your risk management. If you trade it against these rules, you will not be profitable. It is not magic. That is why two people will trade the same model. One person is profitable, one person is not profitable, because the rule must align to that model. So this model states that at 50%, take some profit. That is your TP1. Take partials and wait for the other one to take you to full profit, or whatever it does. If it reverses, no problem. I hope that makes sense. This one says, once price hits 50% of the range, reduce risk immediately. You minimize. If price stalls and ranges after hitting TP, protect capital first. Protect capital first. Price will get close to your TP. It's just ranging there. It's just ranging there. It's just ranging there. You can close the trade and wait for a next setup. I've seen people lose a trade. In fact, my brother is a trader. My direct elder brother is a trader. He trades lower time frame. He gets in on this trade. The trade will remain 3 pips to full take profit. He will say TP or nothing, TP or nothing, because that was the psychology the people he learned from instilled on him. TP or nothing, TP or nothing. This trade will reverse back and take him out on $30, $40 stop loss. And he will be complaining to me. He will screenshot it and send to me. I'll tell him, that is your own trading rules. Follow it. I will not tell you to change your rules, but if these rules are not serving you, refine it in a way to serve you. Some people trade that TP or nothing, and it works for them based on the trading model, their strategy. This model will trade demands that you take partials so that you can make some money before price will react anyhow you want to react, because you are trading on a higher time frame. People that trade on lower time frame, they normally do that TP or nothing. But if you are trading on higher time frame, trade will always react in some zones, and that reaction might take trade back to entry. After it has given you 80%, it doesn't make sense that you still hold a trade that has given you 80% back to entry or even back to SL, and it invalidates. You would say the model is not working. Meanwhile, you are not following the rules of the model. So let's quickly run along. POI rules, point of interest. Only trade at clean unmitigated POIs. Now I'm going to dwell a little bit on this POI. There's a video Sabige recently posted on Twitter. I will advise all of us, it will be to your best interest to go and watch that video. It's 17 minutes. Okay, not Sabige, sorry, Stargirl. Stargirl posted that video on Twitter. 17 minutes video. Stargirl posted that video. It's about this POI, why it fails. Any POI, please take note of this. Any POI inside of a liquidity pool, no matter how valid that setup is, so far the POI is inside of a liquidity pool, it will not hold, because price must take out liquidity. Let me take it again. Any POI, breaker block, order block, fair value gap, whatever POI you trade from, no matter how valid it looks, even if it gives you an A setup, but that POI is inside of a liquidity pool, maybe in a trend line liquidity, maybe it's an inducement liquidity. If that POI is in that liquidity pool, it will not hold. Price will clear that liquidity and go to a place where there's no liquidity and pick orders from that place. After clearing liquidity, it will clear liquidity first before it will react. Sometimes when you take a trade at a POI that is side of a liquidity pool, it will just give a slight reaction. Maybe market is selling and you want to catch a buy trade. Market is coming close to your POI and you want to catch a buy trade. And you enter the buy, price comes to your POI and triggers and gives you 2 pip, 3 pip, 4 pip. It reverses against you, clears out your SL. Because that place is not the valid POI. That POI you took that trade from is a POI inside of a liquidity pool. We are going to have a session on this. Mr. Ebuka will deeply go into the analysis and show you the charts on that. So that is it. If price reacts weakly on POI, do not force confirmation. We have our trade confirmation. If the confirmation is not clear, don't force it. A POI that fails once is no longer high probability. This is just like also telling you if a POI has been mitigated or price has cleared that place before. It's no longer high probability. Sabike calls it fresh level, fresh key level, on fresh key level, and all of that. If it is a fresh key level, it has high probability. If it is an unfresh key level, the probability drops. That does not mean it might not hold. It might hold, but the probability drops. Do not widen stops. Once you set your stop loss, leave it. Let your stop loss be in the accurate place it's supposed to be. Don't widen it. Oh, this is coming to take you out. You want to open it a little bit, open it a little bit, open it. That is the fastest way to blow your accounts. You want to hold the trade. You are stretching your stop loss down. It's coming to, the market is coming to clear it. You keep pushing it down, keep pushing it down, keep pushing it down until finally market will still clear it or you lose the account. If POI is violated with body close, the setup is invalid. Come out of the trade. Come out of the trade immediately. So I think some people are joining. This is one of the most important aspects of this whole risk management thing. Trade management rules. Trade management rules. Once price reaches your first objective, your trade owes you nothing. What is the first objective? 50%. 50%. I'm saying this now because most people will come back and say, Mr. Ebuka, this model is no longer working for me. Why is it not working for me? Why is it working for you? Why is it not working for me? It's working for him because he follows the rules of the model. You are trading against the rule of the model. This model is not TP or nothing. I'm repeating it now. We have TP1. Our TP1 is 50% of the range. You should be able to take partials, take something tangible out of this running trade and wait. And you can now hold to the full take profit. So far it is an objective take profit. You can hold to that objective take profit. After that, the market does not owe you anything again. You wait for the next setup. Break even is a position of strength, not weakness. A lot of people on social media, because the thing about this market is when you come into the market, everybody has his own idea, opinion. People have different background. I was in a live session the other day where Tony Ike was saying he was already making serious money even as a student. He has made his first $100,000. He was a designer, a web designer, a programmer, all of that. You coming from a very low background family does not have that kind of liquidity. You cannot take some risk. You cannot do flipping. You can a lot of things you cannot do. Your uncle that you have begged to send you money has not even sent it. You are coming from a different background. So people are speaking from their own life, from what works for them. Okay, but that is not general rule. People will say never do break even, never do break even. Break even is for there's this one is a break even is for pussies and all of that. You know, using all kind of vile words just to make you feel bad that you are doing break even. If trade gives you some profit, take it. And if you see that trade has reversed against you and the bias has changed, you should break even. It is not weakness. If the bias, the market has changed structure, you are looking at this setup and you see that this setup is actually changing directly in your eyes, you should be able to break even. Don't hold it to the loss just to feel like, oh, I took a loss. Don't be proud of losses. Don't wear it like a badge. I begin to say it. Don't wear it like a badge. Oh, this loss. If that loss can be avoided, it should be avoided. Following your rules. Never let a winning trade turn into a full loss. Any trade that has given you 50% of the range and you allow it to turn into a full loss, that loss is on you. That loss is on you. You are trading against the rule of this model. Any trade that has given you 50% is like your guy in the office paid you half of your salary. That is what 50% means. You work for a full month along the line. Before the month ends, your boss calls you and say, take this 50% upfront salary and just hold it. let's see how this month end will be before you get your full money, and you refuse to take it, and then the month end reaches, your boss is now owing you, and he says you did not actually deliver on what you're supposed to deliver, that in fact he will not pay you. Who took the loss? You. That's what the market does. It gives you 50%, you take partials, take something tangible out of the trade. Don't let a winning trade turn into a full loss. Takes you out completely. If price ranges too long after partial profit, reduce exposure. This is what UJ is currently doing, USDJPY. Gave 50% the first time, gave 50% the second time, gave 50% the third time, and got into a tight range. This is since 2 days now. It's just ranging. If you open the 4-hour chart, you just see price ranging in dodgy forms. Just ranging, just ranging. What do? You reduce your exposure. You can even close. You can reduce your exposure. If you actually took partials at down 50%, what UJ is doing now is none of your business. Mr. Ebuka has actually closed out his trade on the 50%. Once he gave him 50%, he told me, Louis, I want to close out this trade. I said, go ahead and close. He closed it out. And it's on profit. Meanwhile, you will hold it and it will reverse on you and take you out, and you will say this setup was wrong. Mr. Ebuka, why did you put this setup? The model has actually played out, but you did not follow the rules of the model. Protect open profit the same way you protect capital. That running profit, floating profit is not real profit. You can write this one down. Floating profit is not real profit. Oh, $60,000 floating profit. 100. People have lost account because they have screenshotted. In fact, even DAX, on an interview he did on YouTube, DAX, he said he was screenshotting floating profits. The trade will reverse against him, take him out. When he was targeting 1:3, 1:4, 1:5, all these things they said 1:2. You are not a real trader. You are doing 1:2. You are doing 1:1. If a trade is not 1:5, I will not take it. Is market your family house? Market will do what it wants to do. If the setup gives you a solid 1:2, you should be able to leverage it and get paid. DAX now said, okay, what I will do is if this market gives me 1:2, 1:1.5, 1:1, I will take my trade, leverage it, and come out. And that was what he started doing. This guy is just buying properties, buying cars, and all of that. Trading 1:1, 1:2. The same 1:1 they said you can never be profitable trading it. Is when you follow your rules, your trading rules that aligns with your model. When you follow your trading rules that aligns with your model, is when that model will pay you. Every model has its own unique trading rules. Every model has its own unique trading rules. Can you guys still hear me? Can you guys still hear me?
Yes.
All right, thank you. Every model has its own unique trading rules.
Yes, we can hear you.
Okay, thank you. Every model has its own unique trading rules. So not just to learn the model, you must learn the rules that goes with the model. And that is where most mentorship fail, because they will teach you the model, nobody teaches you the rule. Why we are going all in on this is so that we all will be profitable. We are also just starting out. It's not like we kept one money somewhere. It's just this last year we started with the little capital we have. January last year. In fact, we did not start January last year. I think around March last year. And then we started paying for different mentorship, learning online and all of that. Until we refined it to this point where we are now and created these rules that we are trading with. And that is how we have preserved our capital. We've never lost any accounts. Currently, Mr. Ebuka and I, we've not lost any accounts. That does not mean we are not making profit. There are some, like on November, we closed November with $80-something. Some of you are in TLS now, so you see it, $80-something. People were posting $500, $800. The same people that post that big profit. If you see their losses, you will pity them. They over risk, over leverage. They take a trade. They cannot even manage the trade because their emotions are messed up. Meanwhile, we take a trade, we put $20, we hold it to $40, we come out. That is 1:2 solid. You think $20 is not money until you are stranded and you need it and you don't have it. This market pays people that are patient and are willing to compound, especially if you have small capital. You should be willing to compound. You should be willing to compound. You should not be in a haste. Your model works if you take time to allow it to compound over time. At the end of the month, you see that your capital has grown 20%, maybe you had $1,000, now you had 1,200, now you have 1,200. It is massive growth. It's not from $1,000 to $10,000. It does not work like that. It does not work like that. For you to do $1,000 to $10,000, you must be aggressive. And when you are aggressive, you'll be forced to trade lower time frame trades. And that lower time frame trade most times is noise. People come as low as 5 minutes, 3 minutes. I even see people trading 1 minute. I say, what is this? Each candle movement, you are in on the buy, you are in on the sell, you are in on the buy, you are in on the sell, you are in on the buy. You are messing up your psychology. You cannot be a trader long term because one heavy loss clears your account. One heavy loss, all those small money you think you are making, one heavy loss clears it and you are out. But when you trade on higher time frame, the structure is clear, it is stronger, you take your trade, and the pips you cover is massive. Even though your invalidation is a little bit big, it does not matter. That is where position sizing comes in. Everybody should go and learn how to do position sizing. I believe we are not newbies in this platform, so I will not go into that. How to do position sizing, the accurate lot size you should take in a trade to risk a certain amount of money. You can go and ask ChatGPT. If you are trading USD pairs, there's a calculation for it. There are also platforms that help you to calculate it. There are platforms that help you to calculate it. I want to enter this USD pair. I want to risk $10. What position size, what lot size should I use? It will tell you use 0.02 because the number of your SL, the pips to your SL is so and so amount. All those calculations, you should know it. It's not something will come in and start teaching you how to calculate lot size position and all of that, position sizing. You should know it. If you want to risk $10 on a trade, no matter what the SL is, the calculator will not let you know the accurate lot size you will use on that trade. It needs to be the same. That will enable you lose $10 on that trade, so that even when you take the next trade, even with different levels of SL, if your SL is tight on the next trade, the position size calculator will tell you how to, the normal, what they call it, lot size you're going to use. So you need to learn how to calculate lot size. On synthetic, I think there's a platform called Synthetic Lot Size Calculator. We'll post it in the group. Let me not go into all of that. Synthetic lot size, I think synthetic lot size calculator, something like that. For Forex, there's also a platform for it. Synthetic lot size calculator. There's a platform, synthetic lot size calculator. There are different platforms. Synthetic lot size calculator, synthetic lot size calculator, synthetic lot size. So there's one that we use. We are going to post it. There's one that we use. That one is very nice. We're going to post it so you can leverage on that. And there's also the one for trading Forex pairs, currency pairs. Or you can actually get a demo account. You test out your lot size on your demo account before you take it on a live account. You can have a demo account before you take a trade on your live account. Try a lot size on your demo. Okay, 0.01 gives me this lots, this position, this risk. That means what lot size should I actually use? So you test your lot size on your demo, but there are platforms for that, calculating lot size and all of that. So you should know your risk before you enter a trade, not knowing your risk when you are in the trade. So I'm rounding up. Mr. Ebuka will also talk to us before we finalize today's session. Psychological and discipline rules, alignment to our model. Do not measure success by how much you made, but by how well you followed your rule. How well you followed your rule. If you want to measure how successful you are, stay true to the rule. If you are true to the rule and you miss a profit, missing profit is not a loss. Breaking the rule is. Now let me tell you something about breaking these rules. You break the rule once, you break it twice, you break it the third time, and it pays you. The fourth time you break it, it clears all your profits. The fourth time you break it, it clears all your profits. So you don't even gain anything by breaking the rules. Stay true to the rule. The rule says 50% range, I should take partial. 50% range, you take partial. Anytime you say, okay, I must hold to full take profit, and the model is working against you, you are the one working against yourself, not the model working against you. This is one missing piece I feel like a lot of mentors are not talking about. They teach the technicals and all of that, and nobody tells you these are the rules in alignment to this model you learned. Nobody has ever said it. I've been in different mentorship, like I said earlier. I've been in a couple of mentorships. Serious money. Sabi Girl mentorship is the least mentorship we paid for. The least. The least mentorship we paid for is a big mentorship. You can now figure out how much we've paid in mentorships. But nobody has come to say these are the rules you follow in alignment to this model we just taught you. These are the rules to follow in alignment to this model. Nobody has come out to say it. Everybody just say enter here, enter here, enter here. Structural liquidity, this one, that one, that one. Everybody is teaching the same thing, but nobody has taught the rules. That is why we say we are going to be different. We are going to be different. Breaking a rule will not pay you. Number one, learn the rules of your model. Follow the rules of that model. That is why after this class, we're going to post this rule in the group. One good trade does not justify breaking rules. You broke a rule and it paid you now does not mean that is it. You keep breaking these rules until it takes out all the profit you think you've made. In this TLS2, those people posting on one trades, nobody posts their losses. I think it's only Mr. Ebuka and a very few couple people that post losses. Because they cannot post the loss. The loss is massive. The loss is massive. You make $500, but you are losing serious money. You hear me?
Yes, you're right. You're correct.
Thank you, because I know I'm not making it up. They don't post losses. Have you seen any loss in that one trade? But I have access to some of them, and the losses are crazy. You see people taking losses of $800. How much do you have in your equity? And this is not a proper account. This is not a proper account. This is personal equity. All the money you gathered, you want to use in building your personal equity in 2026. You're already taking serious losses. I will see people taking $500 losses, and these are newbies that are just new in the market.
You may be consistent in making $10, $20, and you see somebody that will post that they made $200. But you that is consistent in making $30, you may think that they are better than you until then they lose $700. So that $700 will wipe out, and they use their house rent to trade. It will wipe out all the profit they have made in the year. But you've never had a losing month. You've been consistent in making $10, $20. You now ask yourself, so now you know who is better.
If you calculate what you close the month with and they calculate what they close their month with, you are ahead. You are ahead. Your goal, okay, you are paid for patience, not prediction. Like I said, in this market, you do 90% waiting. You wait for your setup to form, you mark it out. You wait for it to trigger, you enter. You wait for it to play out. There are a lot of waiting. So patience is actually a leverage. In fact, a lot of traders I know that are profitable, they have other things they do. Some of them just buy PS5 and keep playing game if they're not in the market. So far, they set alarm for when they should check what market is doing. Maybe they set 4-hour alarm. I have 4-hour alarm, market closure. Every 4-hour market closure, I have the alarm. So anytime a 4-hour candle closes, I look at the market because I trade on the 4 hours. I look at the market, I see what the market is doing. If the market has approached my POI, it has triggered me. I hold it. I set the next 4-hour alarm. Go back to what I'm doing. I have an active business. I'm married. I should have time for my wife. I have other things I do. So I'm not going to sleep in the market because I want to get profit, even though I want to make money. Do you understand? So you are not overwhelmed by so much time in the market. You just come see what the market is doing. You go back to your life. You have a life outside of this market. You should have a life. Have business relationships, have relationships with people, visit people and all of that. Build your life beyond the market. So the market does not consume you. There's a lot of waiting that traders do. You wait for your setup. You wait for it to trigger. You wait for it to play out. You start again. You wait for the next setup to form. You mark your structure, mark your range, mark out your POI. You wait for it to trigger. It comes into your POI, you get the alert. If you don't know how to set trade alert, go and learn it. These are the things we use. You set alarm for market closure, the time frame you are trading. Me, I trade 4 hours, so I set 4-hour candle closure alarm on my phone. I have 4-hour candle closure alarm. Then I have trade alerts. XNES allows you to do that. TradingView allows you to do that. So you don't have any excuse. When you mark out your POI, you set the alarm, the alert for that POI. On your phone, that POI should be what to call your attention to the market. Not randomly, you are always in the market. Once the alert triggers, I look at my phone. Price is in my POI. I observe it. I confirm, is this trade valid? Is this still valid? Because sometimes market will come to your POI and invalidate that POI. invalidate that POI and break through it and keeps going, you change bias immediately. But if the POI holds, there are some confirmation you will see. You know that this POI will hold. You will enter your trade, set your SL, set your target, and that is it. You allow it run. You start another waiting. I set my this thing at the 50% zone. Once it gets there, it takes out 50% of my profit. Whatever happens is none of my business anymore. I just hold the trade. These are the rules that will help you become profitable with the model you trade. With the model you trade, these mentors, they teach you all these models, but nobody has taught you rules to trade the model with. So for this particular model we are trading, these are the rules. Patience is a key. You spend more time waiting. The only few times you are in the market is maybe you are marking out your structure, you are marking out you're marking out the trade, then you start waiting. You are waiting for it to form. There's a trade that DAX, if you are in DAX Telegram group, he marked out the trade daily time frame. DAX has currently not taken any trade today, January 7. He has currently not, because he marks out his trade on daily time frame. If people are complaining that we are marking out trade on 4 hours, DAX that is marking out on daily. So this thing is serious. Follow it. Then your goal is not to win big today, but to still be trading next year. I want by next year, all of us here are profitable. We are doing fine. All those your goals you wrote down, you have achieved it. Compounding will pay you more than flipping. Compounding, especially as we are all starting out, compounding will pay you more. That $50 you are adding up, $70 today, $50 tomorrow, $30 the next day, you are just adding it. Before you know, in 3-4 months, you have something very tangible. You have enough equity now. Do not increase risk. Let me add this one. Do not increase risk. The risk should be standard across your trade, but what should be increased is your capital. Somebody trading 1% of $1,000 is trading $10. The same person, if he gets a $10,000 equity, that 1% becomes $100. No longer $10. You are still trading 1%, but now you have more capital and your target, you have more profit. Still trading the same 1%. If you now have a $100,000 account, the 1% of that 100,000 is $1,000. Now imagine trading $1,000, risking 1:2. You think 1:2 is small, you are making $2,000, week in, week out, you are making withdrawal. Because this trading, what this trading does, let me round up so that Mr. Ebuka can talk to us. What this trading does is that it makes you look at money as if money is not money. A lot of people are now abusing money. They say, oh, this one is just $50. $50 is what you're calling just. Money is actually money. Stop looking less on money, thinking that money is not money. I'm not saying do not pursue serious profit, but don't look down on any amount. $1 is money. If you are stranded today and you need $1 for something and you don't have it, you are going to be in a very big problem. $1 is money. Don't look at $1 because it is $1. You play around with it. You don't follow your rule. You lose $1 like that. Or you don't take the profit for that $1 because it is $1. Yeah. If it becomes $1,000, how are you going to now manage it? So money is money. Small profit adds up depending on your account size. When you now get a tangible account, you can now start making serious profit with the same risk, the same percentage of risk. And that's why I said my opinion. I'm not saying this as a rule. This is an opinion. If you don't have a tangible account, it will pay you more if you can leverage a prop firm. Whatever one, you understand their rules better. And on prop firms, by default, you don't risk more than 1%. Most of them have that rule. In fact, they even have profit targets. There's a level of profit you should not exceed, which I don't really admire because it limits the trader to bag in more money. Yeah. But I don't think fundedness has that. But they have limitation on risk exposure. Across your account, you shouldn't expose your risk beyond 1%. So if they give you a $10,000 account, don't take a trade that will risk over $100. If you do that and you do that consistently, you will breach that account. They might not call your attention to it initially, but along the line, you will breach the account. They will see it like you are trying to gamble, you are trying to flip. They don't encourage it at all. And they don't encourage scalping. So these prop firms actually sometimes what they do for you is they solidify your psychology so that you are forced to trade within some rules. People are saying that, oh, prop firms are limiting you. Prop firms are actually forcing you to trade within rules because Naturally, man don't like to follow rule. That's why I say these trading rules, 30 of them, is for our trading model. Is for our trading model. You need to learn how to do your position sizing before you enter a trade. You know the amount you are risking, irrespective of the SL. The SL, an SL can be 50 pips. You can risk $10 on a 50 pips SL. You can also risk $10 on a 20 pips SL. The lot size will be different. That's why you need to go and learn how to calculate position sizing. An SL can be $100 pips SL. That SL, you can still be risking $10 on that SL, even though it's 100 pips. If you learn how to calculate it. An SL can be 50 pips. That 50 pips SL can still be risking $10 on that 50 pips SL. The lot size will just be different if you learn how to calculate it. So go and learn it if you don't know it. If you know it, start using it. Risk percentage of your account, not amount. The risk should be in percent, not in amount. When you are risking anything from your account, that risk should be in percent, and it should not be more than 2%. Not more than 2%. If your account size cannot allow you risk 2%, trade prop firm. Trade prop firm. Let's say you have a $200 account. The 1% of $200 is $2. Is it $2? It's $2. So the 2% is $4. So you cannot conveniently risk it. That was why I said until you have a minimum of at least. Except you trade synthetic. Except you fully measure on synthetic. I know traders that trade only synthetics. In synthetic trade, you can risk 30 cents.
V75, they have 0.001 lot size.
Mr. Ebuka is telling me that V75, it has very low lot size that you can risk 18 cents, 20 cents, but you will just be making few money, $2, $3, $4, until you have enough capital. In fact, one of my trading goal for this year, for me, like I said, I'm married, I have a family. I want to be making weekly small money, let's say $50 here and there, just to run my house and all of that, basic necessities in the house and all of that. That does not stop my work, and that does not stop my proper trading. I can be doing that on synthetics. So you can have different accounts. Please let me throw more light on this before I allow Mr. Ebuka come and take over. You can have different accounts. You can have, I follow a girl called Pamela Donald on TikTok. She trades only VIX75. She has a grocery account. She funds it with $100. That account, her target for that account is $10, $5, $2, $1. Every day she does a little bit of scalping on that account. She comes down, she knows her setup and all of that. She comes down, takes her trade. She doesn't even set SL. It was from her I heard that don't set SL. Your SL is the account size. That is her own model. That's why I said everybody trade according to their model. She said she doesn't set SL. That what she does is that the account size is her SL. If she wants to trade, if she wants to do flipping, she funds $20. That full $20 is her SL. If she loses that $20, she takes it as her SL. So she doesn't set SL. She just scalps on that $20, scalps on it. That is for her grocery account to buy things for herself. Then she has project account. Project account, she has $10,000. She trades on the higher time frame on the project account. She has very clear setups. She trades only A+ setups on the project account. A+ only. You don't say, oh, this setup is looking like my setup. If it is not your setup, it is not your setup. She has a project account that is for her building project, buying of any serious thing she wants to buy. That account has $10,000. She takes risk management on that account at another level. Meanwhile, the other one, she's funding $20. She's just scalping on that account without stop loss even. That's why I said every trading strategy, every trading model has their own rules. And that rule, if you follow it, it will work for you. Some people now started trading without SL because she said trade without SL. And they lost their account because they are not trading her model. For you to trade like her, you have to know what her model is. And you trade her model, and then you can trade without SL for your small accounts. But our rule states SL must be specified and applied. You set your SL. We set all these things. Okay. So what am I saying? You can have different accounts. You can have a small account. You can even have Naira accounts. A Naira account, you fund your Naira account with maybe 50,000. You are scalping with that account. In a week, that 50,000 can give you 10K. You think 10K is small until you ask somebody for 10K and the person did not give you. You become angry. that this person did not want to help you. Meanwhile, you don't have it. I do scalping, but that is not I just do scalping by the side so that I can now have time to trade my actual model that I trade without inconveniencing myself looking for quick money. Your trading model does not guarantee you quick money. Just trade that model. Consistency in that model will now be what will now finally pay you. Will now be what will now finally pay you. And last but not the least, before Mr. Buka comes on, do not bend to the market. Allow the market bend to you. You all can see what UJ is doing, what all these pairs have been doing. They are just mostly in a range because market is just getting started this year. Most of the pairs are still ranging. And your setup that you have marked out, market is not in your POI. Market has not approached your POI. You are looking for another POI because market has been ranging. You feel like you have been missing out on trade. Why not let me just take it here? Let me go down to 5 minutes and see if I can take this thing here. You are going to shoot yourself on the foot. Do not bend to the market. If it takes 2-3 days for market to come to your POI, wait for it. It comes to your POI, you confirm that this POI is still valid. You take the trade and wait for it to play out. Sometimes it takes, like Mr. Ebuka has told you guys before, we have a mentor. The guy is also my mentor. He waited 10 months to take a sell on BTC. 10 months. And when the position, everything aligned, he said he gets excited when he sees his setup. It's not when he makes money. He gets excited when he sees his setup. And he loads it. In fact, his own model, this is from him. He said when he sees his setup, he risked 3 to 4% of his account. He of course, his experience, he's been in the market over 12 years, that he can risk beyond 1% of his account because he knows setups that have higher probability. All setups don't have equal probability. And when he sees it, he entered that BTC set with over 200 lots. The guy is a multi-millionaire in dollars. He has made money in the market. Over 200 lots. And when I was speaking to him on the phone, he told me, Louis, I made money on this trade. Before he would say that, because he's not the kind of person that says all of, he's not money-minded and all of that. For him to tell you that, I can only imagine. I've seen one of his accounts where he has liquid money of $1.2 million. This was years back. So the guy he has been in the market for a while. So he waited 10 months to make that money, and he closed that year profitable than people that have been trading in and out every day. So why am I saying this? You should learn to wait. Risk management will test you. But if you can wait, if you can follow the rules, everybody should have an anchor. What do I mean by anchor? A partner that you guys will hold you both accountable. Stanley holds me accountable, Mr. Ebuka. You say, Louis, don't enter that trade. No matter how excited I'm about to enter that trade and it does not meet our setup. If he sees a valid setup, he will call me, share the setup with me. I will say, this setup, this thing is missing in this setup. He says, oh, he didn't say it. And we'll wait. If I see a setup I sent to him, you say, Louis, this setup, the range is not accurate. Look at the real range. We'll wait. We'll hold each other accountable. And that is how we've been in this market. And I've closed the year profitable. Even people that started trading before us have not closed the year profitable. They are in minus, serious minus. So I will allow Mr. Ebuka come and round up the session. Then we can take your questions. And that will be all for now. I hope you guys can still hear me.
Yes, I can hear you.
Yeah. Hello, family. How are you guys doing? All right. Luis have spoken.
Good.
Yes, Luis has spoken the curtains. I want to say something about liquidity, which is part of risk management. I want to focus on this trade on UJ. I'm out of the trade, but I want to show you something, and that's why I also said have this indicator, nephew Sam indicator. Nephew Sam indicator, because you will see where liquidity is. All right, I'm opening it. You can see that it's been ranging in this space since then. So okay, nephew Sam is on. So this was the trade we took. You could see that market came here and broke this resistance. Market came here and broke this. So let me mark it. All right, so this is RBS. And then you have this liquidity sweep, liquidity grab here. This is the liquidity grab. So if we mark the range, all right, so this is the full range. Okay, let me. All right, so this is the full range now. I'm trying to, because the 0.6 should be at the. I'm trying to mark this thing. Okay. So are you seeing this fair value gap? Are you seeing this fair value gap? Are you seeing this fair value gap?
Yes, sir. Yes.
And this one, yes. So if you are, this is why some people say that breaker block, RBS SBR, some people call it breaker block, but I prefer to call it RBS SBR. This is why for some people it does not work. Once price breaks above the high, they come to 50% to take a trade, and that's why it doesn't work for them. And why does it not work? Never ever enter a trade when market has not finished what is doing. Market is always trying to seek liquidity. And if market has not gotten clear that liquidity, it will keep selling. A market that will buy must, first of all, as it's selling, it must clear liquidity. So that is why I say that 0.6 to 0.7 is where the fair value gap is. That is where the liquidity is. There are some people the problem with marking your range on 1 hour is that you will not see this whole range. This is a higher time frame range. There were some people that marked this range on 1 hour, and this was where they entered the trade, and he took them out. Because they did not see they couldn't see this protected zone. Their 1 hour protected zone was this. Let me show you their 1 hour protected zone. This one is their 1 hour protected zone. That's the problem. For some people, the 15 minutes protected zone, a lot of people took this trade and he hit them out. They entered this trade on Monday and it hit them out. Never ever enter a trade when market has not finished clearing liquidity. But with this model, you can enter, and you enter in a protected zone. Now, this is why we say 0.6 to 0.7 is that this is where liquidity is resting. And once liquidity, you can see the first one, market came and cleared it, and then tapped the last one. It was after it tapped the last one, the fair value gap, the last one, that it started, buying. And then it came to 50% of the range. And then it's up. And why do professional traders take profit at 50% of the range? Because as this market did RBS as it was buying, but as it was selling, it also did SBR. So let me show you why market ranges at 50%. It also closed below this low, doing an SBR. So you could see that now at 50%, the SBR is trying to play out. The sell own is trying to play out. The buy own is trying to play out. And all of them are ranging at 50%. And right now, market is just starting. We don't have much liquidity in the market. The year is at a beginning. So at 50%, market faces the first resistance. So your first profit target is 50% of the range. You can take partial or you come out. I'm out of this trade because it was ranging. It's been ranging for days. So at 50%, market has given you what you're looking for. You come out. Market will always give you a lot of opportunities. You always get a lot of opportunities. It's not every trade that will get to full TP. Any market that gives you 50% owes you nothing. Again, you were right. Your POI was correct. And market has paid you. But don't allow market to get to 50% of the range. And because you are greedy, you are trying to get to full TP. And the market will reverse and hit your SL. That will be very, very sad. So when market, most times, so for people, in fact, before market start retracing or start ranging, it will first of all get to 50% of the range. Look at it. Every time it gets to 50%, that's when it starts reaching. Look at this one. It bought to 50% and this spread knows how to do it. And sold even this protected zone, cleared it before it started buying again. So your first profit target is, and in MT5, there's a place where you can take partial. Type on charge, how do I take partial on MT5? There's a place where you can take partial. So you can take partial 50%, or if you don't want to close the trade, you take partial. And then if the trade gets to TP, fine. If it gets to SL, you will not lose in that trade. So, but the most important thing I want to say is don't enter a trade when market has not taken out the liquidity. It has not cleared liquidity. If you are seeing a massive fair value gap, exactly very close to where you want to enter a trade, don't enter that trade yet, because market may likely come back to clear that fair value gap. But if it does not, if that fair value gap is close to your even 0.6, maybe it's between 0.6 to 0.7, and maybe market comes to 0.5 and it doesn't touch 0. It doesn't clear the fair value gap at 0.6, and it never comes back, leave it. It never comes back, leave it. We don't even take trade at 0.5. Leave it, you will get another opportunity. Market will give you another opportunity, and they will come to your POI. Because any market, first of all, comes to 0.5, it tries to buy, later it comes back. Look at this candle. 4 hours later, it came back again to this place. But because there was a fair value gap here, this one tapped into it, cleared everybody out. So some people put their SL here, it cleared them out. That's why your SL must always be at below the range. Not here, not this one. It must always be below the range. All right, we are just rounding up. Does anybody have any question? Does anybody have any question?
Good evening, sir.
Good evening.
So my question is very quick. So which do you think is better? Is it setting limits or waiting for confirmation?
Waiting for confirmation.
For someone that is busy.
Always wait for confirmation. Always wait for confirmation. Always wait for confirmation. When you have developed enough confidence, and you have traded that pair, for long, you understand the personality of that pair, you can set limits, no problem. But always wait for confirmation. That's my advice. Always wait for confirmation. Yes, because the market is not our father's house. Anything can happen. Anything can happen.
Okay, thank you.
Always wait for, especially if you are trading gold, wait for confirmation. No, if you are trading gold, wait for confirmation. Except you are trading JPY pairs and they are not related to US dollar. Those pairs that are slow and all of that. People are rushing to the volatile pairs, but they are the ones that will blow your account. But those USD JPY pairs, it's not even USD JPY, but the ones that are not connected to USD at all, they don't have too much drama. They have even paid out. But yes, the rule, always wait for confirmation. When market gives you that confirmation, you enter. And you may not know that there's a fair value gap. You are setting a limit and there's a fair value gap below your POI, and the market will still go down. Now, if you come to your POI and you're not seeing a fair value gap, go to 1 hour, you may likely see it. On 1 hour, you may likely see it. For example, if we come to 1 hour time frame here, you will even see that POI again. Look at it. You will see it clearly. Sometimes you may not see it on 4 hours. If you come to 1 hour, you see it, and you know that as long as it's there, market will clear it. All right, another question.
Good evening.
Your network is poor. Your voice is cracking.
Can you hear me?
Okay, I can hear you now. Go on.
Okay.
Your voice is cracking. No, your voice is cracking. You said?
I have 2 questions.
Your internet is. Your voice is cracking. Okay, so what you will do? Send me a DM and ask the question on to me on Telegram. Does any other person have any question?
Hello, good evening.
Good evening.
Yeah, mine is not really a question. First of all, is to appreciate you guys Thank you, Buka, and my first time joining the live session. And thank you, Louis. My pleasure to have heard you live.
Thank you,
I'm
sir.
looking forward to joining this time with you guys. Thank you so much.
Thank you very much, sir. Thank you very much. Thank you very much. All right, so we are going to end the session here, and we are going to drop the document in the group. And on Saturday, we are going to do market analysis, market review and analysis, and give our outlook for next week. And then by next week, I'm going to talk about, we'll have a section on Monday, which is liquidity, why most strategies fail. There's a reason why many people have very good strategies, very good models, but it will fail because market moves not with pattern, but with a context of liquidity. Market is always seeking liquidity. And if you don't know where market is heading next, any strategy you use will fail, even if it is on, no matter the time frame, any strategy. So we are going to talk about it on Monday, and it's very, very important because this liquidity of a thing, that is what made me become profitable even faster. I understand liquidity. I always understand why market is failing. Even this USDJPY, I understand that as it's ranging, it can start reacting to a sell key level that is here because market broke a low here, and it can start selling. But market has already given you 50% of the range. The most profitable traders, even hedge funds, most of the profit that they declare in the year is 20%, 30%, 40%, 50%. But I think the problem is that some traders in Africa, they keep talking about 1,000%, making newbie traders think that flipping accounts and getting if you don't get 1,000%, it is wrong. But what someone that is making $10 to $20 weekly, and at the end of the month, that person has a profit of $100, and then somebody that makes $500 in a trade, but then the person lost $5,000, lost all their money, lost the money for their house, lost $5,000, and at the end of the year, they are in debt, a massive debt. Then the person that has been compounding $20 every week has a profit of, at the end of the year, $300, $400, $500, $1,000. So he is better. So that's why it's compounding. In anything that we do in life, it's by compounding that you make progress. It's by compounding that you make progress. So I remember when you told me that by June I will hear your story. But some people, they want to learn something now and they want to make profit now. They want to flip.
Definitely the way we're going. Thank you.
Trading is not a quick lick scheme. You have to treat it like a business. If you treat it like,
So can you hear me now?
Yes, I can hear you.
Okay,
If you treat it like something that will double your money quickly, you will lose all your money. Okay, ask your question.
Okay, I actually have two questions. The first question is on risk management.
Yes.
You mentioned something about risk management. So let's say I have a trade now, like AUD or just say UJ, and it's running. Is it advisable to enter more trades like a different market?
No, it's not advisable.
Or I should wait?
Yes, wait. The opportunities that market gives are endless. Every week, market gives opportunities. This setup, you always see it every week. You know, when you enter a trade, don't try to enter another trade. First of all, it will mess your mind up emotionally. At the end of the day, you may win one trade and lose the other. Or you in one trade you win a little profit, and then in the other one you lose, and it swallows the profit you made in the other one, and so one trade per time. Take one trade per time. Even profits, they don't even allow you to enter. They have rules. They don't allow you to enter trades anyhow.
Let's say I have A plus setup. It's advisable to close the other one, then like a different pair. I have A setup on a different pair. I should close the other running one and take the A plus setup, or I should stay on the running trade and leave the A plus setup.
All right, let me come in a bit on this because I was the one that took that session on risk management. Now, when you, according to this model we trade, when trade has given you 50% of the range, you can take partials and allow the other one to run. Now, do not overexpose your equity. What do I mean by overexpose your equity? You are risking a certain percentage. You are taking a trade with a certain percentage of your account. When it's time for you to start taking 2, 3, 4 trades, you will know. You will know. It's not us that will tell you. when you can afford it. If you feel you can afford it, so be it.
And when you build so much confidence,
when you have traded this model for a while, it is second nature to you. And then you see a trade and it is actually an A+ setup, and your capital can afford to take 5-7 trades. That is up to you. But for now, what we are advocating for is take a trade, let it play out, take the next trade. The opportunities in this market are limitless. The market is not going anywhere. All of us are going to die and leave this market. Traders have traded in the 1930s. Traders have traded when there was no laptop. Traders traded when you have to go in and place your order physically. The buy and sell order, you have to go to there and place it physically. Traders have traded. So we are not the last set of traders that will trade this market. We are going to die and leave this market. This market will continue. So why do you want to stack setups? Because you think, oh, next week there will be no setup. There will always be setup. So what you do is, for now, as you build experience, you build capacity, you build capital, you build experience, you build capacity, you build. Anytime you spend in the market, take trading that model, it reinforces your experience, it reinforces your capacity, and as a byproduct, it reinforces your capital. The capital is just a byproduct of you focusing on the model. So when you now grow to a level where, if you are trading prop will tell you, do not overexpose this account beyond this percentage. Even if you want to take 3 trades, then you can drop your percentage maybe on this trade.
If you want to take so many trades, then reduce your percentage. Let it, at the end of the day, still be that you are risking only 1% of your account.
Per time, per exposure.
Because before you take a trade, you should not be asking how much should I make in this trade. You should be asking how much will I lose if the trade goes against me. So if you ask that question and you know how much you are risking before you enter the trade, it will now show you whether you take a trade or not. I saw a very good setup on EU, which is my main pair, but because I was already on UJ, I did not take it. You need to ask yourself, because I want my risk to be maintained. I have a 10K profit account and I'm risking only 1% of that account, which is $80 to $100. I cannot risk more than 1% of that account. So the risk, what you are risking, should determine how many trades you take. If you want to take maybe you have built so much confidence, you want to take on different pairs, fine. Let it still be that 1% of your account. But don't go and now, because you saw 8% of, you now risk 100% of your account or 50% of your account. Market can go against you and you lose everything, you lose all your money. Meanwhile, you may lose all the profit you made last year in one trade, which is very wrong.
Or one trade will be giving you profit, the other one is giving you loss.
You will not, you'll be unsettled, and it will spoil your day.
So the trade you took that is giving you profit, you jump in on another trade without allowing this trade to play out, and that trade is maybe in a drawdown.
It's like asking, if my wife is pregnant, can I impregnate her again? Let her finish giving birth, and then before she gets pregnant again.
Sorry, that is not a good analogy.
My second question is on execution. So if, let's say, I have marked up and market is reacting from 0.618.
Yes.
Is it advisable to go on the lower time frame, like 5 minutes? Get a confirmation. Let's say I see pin bar on 5 minutes.
Yes. You can get confirmation on 15 minutes, 5 minutes. People have different lower time frame confirmations. In fact, as you trade the model, you develop your lower time frame confirmation. But make sure that the stop loss is the 4-hour range stop loss is where it should be on the higher time frame, not on the lower time frame. Yes, you can develop your lower time frame confirmation
when execution after getting confirmation.
Yes.
Okay.
Yes.
Thank
when
you.
market comes there, you can you can.
Okay, I don't know if Mr. Ebuka has taught you guys about time frame correlation. So if you mark your structure and your range on the 4 hours, the lower time frame that correlates with it most of the time is 15 minutes. So most likely you might get your confirmation on the 15 minutes if you mark your structure on the 4-hour time frame. Then 1 hour time frame correlates mostly with 5 minutes. So those are for confirmation entries. You just see that, okay, this price, you come down, you see any of your candle patterns that confirms that this trade is aligned to your strategy, you just take it. So that's how it works for confirmation entries on the lower time frame. One of these days we are going to show it, but for now, focus on this one for now. Except you already have your own confirmation strategy. You
have.
Okay.
People have.
Okay, no problem.
All right. Any other question before we close? All right. No further question. Thank you so much, everyone, for joining us. Yes, we are going to send the recording to the group. Thank you for your time.